If you find yourself retired before age 65, or that's your goal to retire before age 65, you may be wondering how you can have health insurance for yourself, being that you're not yet eligible for Medicare. Well, in this video, I'll talk about the 5 different ways that you can get health insurance for yourself to cover your health-related needs until you become eligible for Medicare at age 65. Welcome back. This is episode 237. I hope your 2025 is off to a great start. And through various studies that are done as far as what are the biggest concerns that retirees and pre-retirees have, one of the top concerns is health insurance. And if you're a pre-retiree, you might be wondering how you can get health insurance if you retire before age 65. So in this episode, I'm going to be talking about how you can get health insurance before age 65, what those different options are, what the cost might be, and also some ways that you can potentially lower the premium cost that you will pay for this insurance. Now, if you're like most people, you probably set some goals for the new year, and hopefully you're still on track to achieving them, but maybe some of them have fallen by the wayside. But if one of your goals is to develop a plan for retirement, then maybe you should consider hiring a financial advisor. Not just any financial advisor, but a fee-only fiduciary advisor. This fee-only fiduciary advisor will put your interests first, and I've written a book to show you exactly how to hire the right financial advisor for you. So in the book, I walk you through how to find, hire, and establish a relationship with the fee-only financial advisor. I also talk about how to get the most out of this relationship, what pitfalls to avoid, and I'm currently giving away a free full electronic version of this book. To get it for free, that's right, for free, you just need to head over to retirewithryan.com and click on download a free copy of the book. You just need to provide your name and email address. So retiring before 65, it's definitely a goal that some people have, but one of the biggest challenges with that is what will you do for health insurance? Because obviously, if you don't know, you become eligible for Medicare at age 65, and for many people, the cost of Medicare is usually less than the cost of some of these other options that we'll talk about. So if you do have a goal of retiring before 65, you do need to have a plan for how you will handle your health insurance coverage and your health insurance costs before you reach your 65th birthday. So I'm going to walk you through what 5 of those ways are and talk about some of the pros and cons of them, and then also talk about a few strategies that you can use to potentially help save costs that you will have to pay, premium costs for one of these options. So option number 1 is generally the least desirable, and I'll be going through these options listed in order of desirability. So option 1 would be you could have no health insurance. Believe it or not, there was a penalty for health insurance years ago, but that penalty went away, and that penalty has not been put back into place. That penalty, we'll have to see what happens, but most likely won't be going back into place because President Trump and the Congress that was there when he was president were the ones that canceled this policy that had previously been put into place as part of the Affordable Care Act. So you could decide to not have health insurance. Obviously, it's not a great idea. There could be, just a little accident that you have that could be extremely costly. If you do have a long hospital stay, we know that will be extremely costly, and health insurance is one way that a lot of people become bankrupt due to the cost that they have to pay. So you can decide to do that, but obviously it is a risky choice. And I think you'll see as we go through these options that there are some other options that make a lot more sense financially as far as protecting yourself, but also aren't extremely costly to get them. So option number 2 is that if you are an individual with a very low income, you could potentially go on Medicaid in your state or your state's version of Medicaid. So where I live in Connecticut, the Medicaid program is for people that are not yet on Medicare. For younger people, that is, under 65, is known as Husky. And this is generally for people that have minor children or are in need of care. Could be single individuals, even married couples who have extremely low income. So usually as a married couple, your income has to be under about $25,000 to qualify for this coverage, or as a single person, under about $17,000. If you have a child, the more people in your household, I should say, the higher your income can be to qualify. So this is definitely an option, But again, your income would have to be very low. So what counts as income? Well, if you're working at all, obviously that would count as income. If you have income you're taking from your portfolio, distributions, dividends, interest, that all counts in this calculation. So it is possible that if you had a lot of money in cash and you were just living off of that cash and drawing that out, that wouldn't count as income, and you could potentially get Husky and have that coverage be in place until you turn 65. And there is a very low cost for Husky. I think in some cases it's totally free. So it is an option, but again, it's for people that have very low income. Option number 3 would be that you could continue your existing health insurance that you had with your employer. If you were previously employed, you had health insurance through your employer, you could continue that coverage. This is known as COBRA. And the biggest difference is that with COBRA insurance, you're paying the full amount of the premium plus a 2% additional surcharge of that monthly cost. So let's just say, for example, you're working for a company now, you're paying $200 a month for your health insurance because your employer is subsidizing a large portion of that cost. And maybe the full cost of this premium would be $1,000 a month. So if you retired or left or were laid off, you can go on Husky for any reason that you had a former job and you decided you want to keep your health insurance. Well, you would pay $1,000 a month plus a 2% premium. So it can be rather expensive keeping Husky. But why might you want to do it? Well, if you had retired or left that job close to the end of the year and you've already met your deductible on that plan, if let's say your deductible was $4,000 for out-of-pocket expenses, you've already met the deductible, it could make sense to keep to keep your COBRA, because that would then allow you to not have to pay any more out-of-pocket costs. You would be paying the monthly premiums, but it's possible that could be less money for you. So it really depends upon what the full cost of this insurance is going to be for the full cost of COBRA. Now, how long can you keep it? Well, you can keep COBRA for insurance for up to 18 months. So if you happen to retire, let's say, at age 63 and a half, and you wanted to get yourself to age 65, you could potentially keep your COBRA for that roughly half a year, and that would then get you to age 65, and then you'd be able to go on Medicare. Additionally, maybe you really like your health insurance. Maybe the company that administers it is easy to deal with. Maybe it is a good benefit that you have a low deductible, good coverage amounts. So there's other reasons to keep it. And obviously, just keeping it could be less of a hassle because you're not going into a new plan. So option number 4 would be to investigate the individual plans that are available within your home state. Now, there are a number of insurance companies, it depends on the state, that sell individual plans in your state. So they could be plans that are for an individual. It could be for you and your spouse. If you have children, it could be a family plan. But they're plans that you are buying individually. So you'd have to really look into these plans and see what you're after. The best thing to do would be to talk to an insurance agent who deals with health insurance and really could guide you to tell you whether or not these plans would make sense versus keeping your COBRA insurance. So you could find out, let's say you're looking at an individual plan and it would be $500 a month and it would be a $6,000 out-of-pocket deductible compared to your COBRA insurance that maybe was only a $3,000 deductible, but it was going to cost you $1,000 a month. You'd have to weigh the pros and cons of that and to decide what policy might be better for you based off how often you go to the doctor. So getting an individual plan could make sense. It just really depends on the cost and that comparison with COBRA, if COBRA is an option for you. So option number 5 would really probably be the best of all these options, and that would be getting an individual health insurance plan through the Affordable Care Exchange. So we talked earlier about Obamacare. Obamacare is what created the Affordable Care Act, and this is where you get an individual plan. Could be for you and your spouse, could be for you if you have children, dependents. And however, the biggest difference is that you're eligible for some type of a subsidy. So that subsidy is really dependent upon your income, just like it was with option 2 with Husky. So every state, some states have plans, I should say, not all states. So the states that have their own healthcare exchange are California, Colorado, Connecticut, District of Columbia, Idaho, Maryland, Massachusetts, Minnesota, New Jersey, New York, Pennsylvania, Rhode Island, Vermont, and Washington. So why am I pointing that out? Because if you live in one of those states, that state has its own healthcare exchange. Like in Connecticut, it's called Access Health. If you were to go on the Connecticut exchange, if you live on Connecticut, you click on Find a Plan, you put in your information, what county you live in, what your age is, what the ages of your family members are, any dependents, and then you also put in your income, your projected income. And then you click a few buttons and it takes you to showing you what your projected premium would be. It tells you how much of a subsidy that you qualify for. So this could be significant benefit to you because it used to be a few years ago that the subsidies, really before COVID, were very specific in the sense that based off your family size, there's a federal poverty level limit that your income could be up to. And if you went $1 over that limit, you would completely lose your subsidy. Well, the way that the subsidies work now is that they're tiered. So you don't completely lose the subsidy if you go over the limit based on your family household size. So the subsidies are very generous. So again, if you live in a state that has their own exchange plan, go on that state's exchange plan. You could Google that state's exchange plan. Or if you live in one of those other states that doesn't have the plan, then you want to go to healthcare.gov because on there you can do a similar thing where you can look at quotes and you can look at numbers. So if you're somebody who's going to be retiring before 65, you definitely should go and do this, and you should look at the exchange and you should play around the numbers, what your projected income you think is going to be, to see what the subsidy is that you would qualify for. Now, you can also reach out to an insurance agent. I would definitely suggest doing this. They know about these plans. You can see the different plans that are available. They can maybe make some suggestions based on your situation as far as the plan that would make the most sense. The nice thing is, the way I understand it with these plans, is that all insurance agents get paid the same amount of money for these plans. So they're not really in a position where they're going to tell you to go with one plan over another. I believe they're getting paid the same amount of money when they sign someone up. They get a monthly fee. It doesn't come out of your pocket. It comes out of the premiums that you pay. So it does make sense to look for that help. So again, you put in your information based off the family size and your income, and you can see what those subsidies are. And for many people, unless your income is really high, and again, put in your numbers and see what your income is going to be, then you're going to qualify for some type of a subsidy. So what qualifies as income? Well, just like I mentioned earlier, if you're going to work at all, if you're going to take distributions from your retirement accounts, if you're going to realize capital gains in your investment portfolio, if you have dividends or interest, this all qualifies as income. So you have to do your best to estimate what that's going to be. So this brings me to what I mentioned earlier, which is how can you save money on the cost of the premium that you're paying if you're going to be eligible for an affordable care subsidy? Or if you want to become eligible for an affordable care subsidy, what can you do to lower your income? Well, you can definitely control where your income comes from. So if you're someone who's retiring and you have a large amount of money in an IRA or 401k, and you have some other money that's in a non-retirement account, maybe you could structure your income so that you take a limited amount from your IRA or 401k, and you take the other money from your taxable investment account or from your savings so that you don't have a lot of income, so therefore you qualify for a subsidy. You could have millions of dollars in the bank, and again, it's not based on your net worth currently, it's based on your income. But if you're not tapping that money, if it's millions of dollars, let's say, in a retirement account, and you're not withdrawing from that, you're not creating income, then you're going to have a lower income and you could qualify for a higher subsidy. So this is something that you can do. You control where your income comes from. So that's one thing that if you find yourself on this plan and qualifying for it or want to qualify for it, maybe you can structure income so that you take less out of your accounts to qualify for a higher subsidy. You also can maybe spend less for a couple years. Let's say you're retired at 63. You're going to be on the Affordable Care Exchange for 2 years. You could maybe take lower income so you got a higher subsidy, knowing that when you turn 65, you're going to take some more out of your retirement accounts because you're going to have a higher threshold based on the ability to take more when you're on Medicare versus when you're on this subsidy. So that's something you can do. If you're planning ahead for going on these subsidies or qualifying for the subsidy, you also could maybe take money out in advance of when you need it. So let's say that you weren't going to go on the Affordable Care Exchange until next year. Maybe you take some distributions from your retirement accounts this year where it might not impact you as much tax-wise, and then next year you use that money, you would set that money aside, and you're using that to actually live off of so that you have lower income in those years where you're going to qualify for the subsidy. So there's definitely some planning that can be done. Now, the biggest unknown about the Affordable Care Exchange is whether or not these subsidies are going to exist the way they do today next year. Because these subsidies, I believe, are set to expire the way they're calculated this year. So we'll have to see if Congress extends them, if they go back to the old way where they were calculated, was a very strict number that if literally you went $1 over your threshold, you completely lost your subsidy, or if it will stay the way it is and it will be more of a gradual reduction so you don't totally lose your subsidy if you go over your income limit for your household. So definitely some things that you can do and you can consider working with your financial advisor as far as structuring your income to see what type of subsidies you can qualify and taking advantage of some planning, but also finding an insurance agent, possibly through your state's healthcare exchange, that can help you to guide you on what these options are and what can make the most sense for you. So as always, if you have a listener question that you want to have considered for your future episode, you can head over to retirewithryan.com and click on Ask a Question. And if you haven't checked out my book and you're looking to plan more for retirement and hire a fee-only financial advisor, you can also download a free copy of my book by going to retirewithryan.com. Have a great week, and I look forward to talking with you next Tuesday. Take care.